Now, we've seen a lot of layoffs in the tech sector this year, with major companies like Meta, Amazon, and Microsoft cutting jobs. But it's not just tech where we're seeing a slowdown. Far fewer jobs are being posted in industries ranging from healthcare to finance, even to science. This is data from ZipRecruiter since June. And my next guest is ZipRecruiter's chief economist. She says all of this is telling her one thing: we're in a white-collar recession. For more, joining me now, let's bring in Julia Pollak from ZipRecruiter. Julia, it's great to see you. Do we call it a recession yet, or is this just a slowdown?
Well, so far, in the aggregate numbers, the labor market is still very strong, right? The last jobs report showed 60% more jobs added across the economy, and those jobs are still being added across a very broad set of industries. But if you look at job openings and if you look at layoffs, you can see that layoffs have risen most in white-collar industries like real estate, information, and financial services, and that job postings have also declined most. In 6 of the 7 industries with the largest declines in job postings since June, which is when job postings started to sort of change and turn over, those industries are very, very white-collar industries that have been growing by leaps and bounds in recent years.
Can you contrast that with, I don't know if ZipRecruiter has as much data on so-called blue-collar jobs, but is that part of the economy holding up much more strongly?
It's holding up much more strongly. And by contrast, job postings have risen 24% in personal care services. That's things like hair salons and nail salons and laundromats and dry cleaning services. They're also up strongly in travel and in healthcare. And healthcare, of course, has very strong long-term prospects and doesn't typically lose jobs at all in a recession. And with an aging population, that industry is likely to continue growing.
Yeah, that's been one area where we've almost, it's been almost recession-proof for quite some time. So just because we're seeing a pullback in job openings, does that necessarily mean the next step could be layoffs? Because this is such a strange environment where we've had so many job openings in the economy. The Fed is literally targeting it to try to dial it back some, but without causing a bigger kind of labor market recession. It's not clear if they can kind of thread that needle.
So overall in the economy right now, there are about 1.4 million layoffs and firings happening each month. That's about 500,000 fewer each month than before the pandemic, when there were 1.9 million a month. Okay, so overall, workers have never had it so good. They've never had this much job security. That said, if you look under the hood a little bit and you look by industry, layoffs and discharges, if you look at this quarter versus the previous quarter, are up 38% in real estate, up 21% in information, up 20% in financial services. They're also rising in travel and transportation and warehousing. Those are industries that grew very rapidly when people were spending on goods, when they couldn't spend on services during the pandemic. But now that people are shifting back to services, we're seeing truckers and warehousing workers getting laid off as well.
Yeah. Do you think this can stay contained to these certain white-collar industries where things are slowing, or do you think spreading it out and unfortunately signaling a broader downturn is probably what's happening here?
So I think the number one factor to look at is the strength of the U.S. consumer. And we've all seen the chart that shows credit card loan debt returning to its pre-COVID trend. And it looks pretty alarming, right? The fastest growth in credit card debt sort of on record. That said, if you look at those data in context, if you look at credit card payments, debt service payments as a share of disposable income, they're still historically very low and way below pre-COVID levels. And if you look at delinquencies in when it comes to most kinds of loans, they're still falling or flat and very, very low by historical standards. So the consumer does not yet appear to be hurting and pulling back. And if consumer spending on goods and services remains strong, we might just see the labor market kind of tilt back to normal, but not actually fall into recessionary territory.
Yeah, wouldn't that be nice? By the way, do you guys have any data on wages to indicate where that important source of inflationary pressures is headed or heading?
Yeah, so finding out what's actually happening with wages is one of the hardest things to do, because right now the data are very mixed, and these averages that we get from the Labor Department are often distorted by shifting industry mixes of jobs. That said, we have a great survey of 2,550 workers hired in the last 6 months. And we ran that survey in February and we ran it in October. And we found that the share of workers who got double-digit pay increases, the share of job switchers who got double-digit pay increases rose from 31% in February to 43% in October. We also see that the share getting signing bonuses went up, not down.
Wow.
And so reports of the labor market cooling, broadly speaking, may be exaggerated still. In those blue-collar industries and manual services, employers are still rolling out the red carpet for workers and are still facing incredible competition for talent.